So this question comes in from Glenn via email, as well as our client Brian, who asked me about the stock just the other day. And it is on Kraken Robotics Inc. or PNG on the TSX Venture, currently trading at a price of about $3.38, about a $1 billion market cap following its most recent equity raise, and it does not pay a dividend. Now, Kraken is a marine technology company which produces optical sensors, batteries, and underwater robotic equipment for unmanned underwater vehicles, or UUVs, used in military and commercial applications, with about 80% of revenue coming from defense and 20% coming from commercial. And the company is based in St. John's, Newfoundland, and has operations throughout North America and internationally, with approximately 2/3 of revenue coming from North America over the last 2 fiscal years. And it operates in 2 segments: its products as well as services, with over 2/3 coming from the products segment. Now, the stock has performed very strong over the past 3 years, up over 750% since late 2022, and up about 190% over the past year. And we've interviewed Kraken's management team in the past and covered the business on the podcast a few times now, with Aaron covering them back in the summer of 2023 and 2024, and Ryan covering them more recently in the spring of 2025. And over this time, we have really seen the business go from a money-losing business, which has transitioned into more consistent net profit. So let's take a look at where they are today under the scope of our growth at a reasonable price, or GARP, investing criteria. Just to go over some operational updates here, on July 7th, 2025, the company announced that it had closed its previously announced bought deal, issuing 43.2 million common shares at a price of $2.66 per share for gross proceeds of about $115 million, with the proceeds expected to be used for enhancing its balance sheet for acquisitions, working capital for larger potential contracts, and general corporate purposes. Now, this will place the company's outstanding share balance to over 300 million shares. And as you can see on the right-hand side of the screen, the company is not afraid of dilution, issuing over 150 million shares over the past 5 years. And you'll see that's why their balance sheet looks so robust. Now, the company has consistently been bringing in contracts as well. And as Ryan discussed in our last segment, he clarified details around its new Halifax-based battery manufacturing facility, which is expected to cost $10 million to construct and will be operational by Q4 of 2025. And it is estimated to produce up to $200 million in annual revenue at full capacity. I believe the facility is about 60,000 square feet. The company has also made acquisitions, such as its deal of 3D at Depth for US $17 million, which reported revenue of US $14 million and operating income of US $1.1 million in fiscal year 2024, as well as they've announced partnerships like its a partnership with Seabright to enhance their complementary system offerings, and their Cooperative Research and Development Agreement, or CRADA, with Naval Undersea Warfare Center Division, Newport, to advance signal processing techniques for the current and future generation of synthetic aperture sonar, or SAS, sensor technologies. Now, one thing that I will note here, though, just referencing these contracts, is the company does not report a backlog figure, which I would really like to see them do in the future. But at this point, they do not report backlog. So looking at the financials for Q1 of 2025, ended March 31st of 2025, revenue was down 23% to $16.1 million, with growth of 38% in its services segment, while its product revenue declined 42% due to lower revenues related to the RMDS program. Note, though, that this is a contract-driven business, and year-over-year quarterly variations can be quite volatile. So it is good, to get an annual picture of things as well. Now, gross profit margin was 62.7% compared to 44.8% for the same period last year. The increase is related to higher margin projects in the quarter compared to the same period last year. Net income was $250,000, or nil on a per share basis, compared to a gain of $2.1 million, or 1 cent per share in Q1 of 2024. And the company posted adjusted EBITDA of $2.8 million, which was down 32% from the same period last year, with the decline in profitability due primarily to a decline in revenue, as well as an increase in administration costs. And I'll also note here that there was a large deferred tax recovery in Q4 of 2024, which inflated reported earnings. And when we go into my valuation section in the coming slides, I do adjust this out, but I'll mention that again. Now, looking at the balance sheet, remains relatively healthy with with cash, of 59.3 million and debt and leases of 30.5 million, providing a net cash position of 28.7 million, or about $1.48 per share. Now, keep in mind the next quarter of Q2 2025, which will be for the period ending June 30th, 2025, will not include its recent cash raise through the equity raise, but by Q3 of 2025, this will begin showing on the balance sheet, as well as the 300 million shares as a new denominator for its shares outstanding, or EPS, I guess. Now, looking towards fiscal year 2025, management expects revenue of 120 to 135 million, which represents growth of approximately 40% over fiscal year 2024, and adjusted EBITDA of 26 to 34 million, which is expected to be growth of about 50%. And looking at the valuation, this places the company at a pro forma enterprise value to adjusted EBITDA multiple of about 22 times. And this pro forma is taking into account the recent equity raise. And looking at trailing numbers, it's trading with a trailing enterprise value to adjusted EBITDA multiple of about 44 times and trailing price to adjusted earnings multiple of 99 times, which all I'm adjusting out from earnings is foreign exchange gains or losses, as well as deferred tax recovery, which I was mentioning, which with primarily, it was an $8.6 million gain in Q4 of 2024, which boosted reported earnings. So to conclude here on Kraken, Kraken is a fundamentally strong business which checks off several boxes from our growth at a reasonable price investment criteria, including good historical growth, strong backlog with new orders coming in, but it does not disclose their backlog figure. I'd love to see that in the future. They do have a runway of growth and a new capacity coming online with their Halifax facility. They have a strong net cash balance sheet. Now, some negatives is that the company is not scared of dilution, and despite strong revenue and net income growth, the business was only able to grow adjusted EPS at about 13% in fiscal year 2024 over fiscal year 2023, which is still good. But when we're looking at adjusted net income, it was up 23%. So we're seeing that dilution take effect there, where EPS was growing at 13% while net income was growing at 23%. The caveat here, though, to the dilution is, though, that I would like to say is that at least they are raising capital at these valuations, which in my opinion are pricey. So, on to the next point, the valuation remains pricey at this point with a pro forma forward EV to adjusted EBITDA multiple of 22 times. The growth is strong, but for it to continue to maintain this valuation, growth must be upheld, which is a risk in a lumpy contract-driven business. I don't think that the valuation is insane. The long-term, investor, the company will likely grow into this valuation more, but it is pricey. There is risk there. Peter Lynch always talks about, good businesses can become risky investments when you start to overpay for them. So this is really the question here: is are we beginning to overpay for this business at this point in time? And the last point that I'd just like to make is global defense spending is certainly a tailwind for the business, but tariffs also pose a risk. Brett and I were recently just going through some U.S. small cap companies recently, and we pulled a company which is quite interesting. I just kind of want to contrast it a little bit. So the company that we pulled out conducts aerospace training, which is about 68% of revenue in its Q1, and about 32% of revenue is from the commercial and industrial. Now, backlog on that business remains elevated. They actually report their backlog. It's up because they reported a very large $85 million contract, and the company is trading at under $1.35 per share and has a trailing price to adjusted EPS multiple or valuation multiple of just 3.3 times. and an enterprise value to EBITDA multiple of about 4.5 times. So, the valuation there is great. Realistically, we want to see, the growth path forward for this business. Now, the balance sheet on this business that I'm talking about is not as robust as Kraken's, but this company hasn't been a serial diluter like that of Kraken. Anyways, I just wanted to kind of contrast, what we're looking for in the market. There is value out there, but we'll certainly be reaching out to that other company's management team that I'm referencing to see, if there is this growth path ahead and if they can fit into our GARP model and become a recommendation for our clients.
Yeah, and Kraken's growth has certainly been tremendous. That is a $115 million financing. Interesting to see how they deploy that. The company talked about net proceeds of the offering being able to use to support the company's growth into a scalable global prime contractor, looking at enhancing the ability to consider large accretive acquisitions, particularly in US and Europe, given the company's strengthened global profile. And number two here would be demonstrating a stronger balance sheet when bidding for larger government and commercial contracts and for general corporate purposes. It looks like the company is looking at attaining the next level in terms of being a contractor, but also looking at some M&A. So we talked about M&A in the previous segment. Is Kraken going to be able to responsibly grow via M&A accretively on a per share basis? If they can do that, Kraken can be a great investment. If they don't grow on a per share basis, then we'll be revisiting Kraken as a name that didn't grow on a per share basis and the share price doesn't do well. Certainly, the market is pricing them at present like there is going to be significant growth going forward in the defense industry. It's got some wind at its back, so we'll see if that continues.
Certainly. Yeah, so on that wind on its back, at the end of June, NATO actually announced increasing expenditure to 5% of GDP, but that also includes 1.5% of critical infrastructure. So it will be more 3.5% compared to what they are. And what I have up right now, you can see every single country besides Poland and NATO right now actually is spending well below it. Canada, you can see here. Very bottom left besides Belgium. And as well, if you look on the horizontal axis, you can see like Luxembourg, Spain, Slovenia, all about the same spending as Canada, but every single country well below that 3.5% besides Poland. So if we do see this massive influx of spending, and this is until 2035, whether or not countries actually follow through with what they're saying is another question as well. As you can see, there's quite a few countries, including Canada, below that, the current 2%, which I think was initially 2025 or something. So this year, I don't think that's happening. But this would really help the entire defense industry as a whole if you do see, because these are massive, really, it's the Western sphere of influence in general, would be backing defense spending of 1.5% increase in reality. So that would be the Krakens of the world. It would be the company that Brennan is talking, as well as anything else, fear in which Ryan was talking about earlier, what can benefit from some increased defense spending as well. It can be a massive boost of spend. When you hear about fiscal spending increasing economic activity, that's exactly what it is. Whether or not you agree with that policy or not is another question, but that would increase the really tailwind behind most defense stocks, but it really depends on the individual company, how it actually plays out. So if Kraken may not benefit at all from increased spending, especially these smaller companies, you do have to still follow their contracts, because if they aren't able to actually realize any of that benefit, it isn't going to ultimately benefit the stock, even if the stock price goes up 100, 200% just on these types of announcements and increase in spend from a macro point of view.
Yeah, and I do caution when these broad announcements are made, the market gets very excited about spending going into defense. You're not going to see it in the next quarter. Typically, often in this area, it can take years to really kick into the financial numbers of these companies. And we look at a company like NTG Clarity, where the Vision 2030 plan was announced years and years ago, and really it doesn't make it into the numbers and affect that business, for example, just in the last year is really where you're seeing it hit those the numbers of the business. So if you're planning on hearing this announcement that Mark Carney's planned to increase defense spending massively, and then you're looking at Canadian defense related companies and expecting a jump in the per share earnings or expecting a jump in revenues in the next quarter, you're often sadly disappointed. We would say that, you need to take a long-term view there and be careful that the companies don't get bid up to valuations where they're pricing in this Pollyanna scenario. And, there are some companies right now that are kind of Pollyanna-ish priced, and we'd be cautious there. There will definitely be some winners. You want to look at the companies that are existing, financials are good, and have the bonus potential of getting a windfall if this type of spending moves forward.